presentation contains current opinions of Moe Sansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compak Asset Management YouTube update. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. This is for August the 16th, 2022. I'm doing this after the market closed today on Tuesday. Let's start with this week. I'm going to talk about the Fed. What are the expectations of the Fed? As you heard today on the daily broadcast with Jeremy Siegel, the professor, as I call him, the Wizard of Wall Street, he was last year predicting the Fed was behind the curve. This one now he's saying something different as we talked about that, and I'll talk about that a little bit later on. The market and the midterms, everybody is now starting to talk about the elections. What impact do the midterm elections have on the market? We will take a look at all of that and talk about that in a little bit of detail. Where the economy is, technical analysis, markets looking much better now, and outlook for the week ahead. So let's start with the Fed. This week, again, expectation is that the rates will get to about 3.75 to 4% by the end of this year. That's what the expectation is. We are at about 2.5 now. Expectation is that we are going to get another 50 basis points in September. Then we get another 0.5%, a quarter or a half, depending on where we are in November and then December. That's the Fed fund. I think this is a little bit of a rosier picture than what the Fed has said. The Fed has said they're going to continue to keep the pressure on. Now, we do get inflation data for this month at the beginning of next month before the Fed meeting. The next Fed meeting is going to be on September the 22nd and 21st. That's when they're going to announce their rate increases. Now, is it going to be 0.5% or 0.75%? That's the argument right now. The market, I think, is expecting 0.5% or lower. That means the Fed is slightly taking the pressure off the brakes on the economy by raising interest rates less than the 75 basis points or 0.75% that they have done at the last two meetings. I'm not quite sure the Fed will. I think the Fed wants to make sure that everybody realizes that they are going to kill inflation no matter what. And they're going to err on the side of caution unless we get a much lower inflation number for August next month. That is a possibility because of oil prices. They are below where they were before the war started in Ukraine. Gas prices are still up, but that's what happens. Prices go up very quickly, come down very slowly, and that's what we're seeing. But that is the expectation. But I think the market has gotten ahead of itself and is looking at this as rose-colored glasses. With rose-colored glasses now, I think just like in June, everybody's saying, oh my God, the Fed's going to raise 1%. They're running around, the world's ending. And now we've come to the other extreme where everybody's saying everything is okay, folks. And reality is always somewhere in the middle, and that's where I think we're going to get to in September. As we get closer to the meeting, there'll be more anxiety and more volatility in the market. We're looking at inflation is starting to surprise to the downside. Folks, if you've been coming to my seminars, webinars, we expected inflation to peak somewhere in the middle of this year and started to roll over. That's what we are starting to see, where we are seeing the most of the surprises are to the downside in inflation. Again, still a lot of inflation coming from energy. That's the green part. New and used vehicles, they're starting to stabilize. I think all the dealers that were looking, their inventories are going to start going up and they're going to start discounting again. Food, restaurants, and shelter still continues to go up. As you know, these are rents, the dark blue one right here. And I expect the dark blue to continue to do that it is going to continue to go up. How much is this going to contribute? And will this take over from here? I don't know. We'll have to wait and see. Markets, midterm elections, you can see that going back to 1962, we've had a number of terms. This is where the blue is when the Senate flipped control here. This is where the Republicans took control during Bill Clinton, where everything flipped from Democrat to Republican. Here we flipped from Republican to Democrat. Here the Senate and so on. But you can see that 6 months after the election, markets are up nicely. That's what we have seen every single time. An average 6 months later, after the midterm, market is up 15%. 12 months later, it is up 16%. Coming into it, you can see that we have a lot of negative numbers here. The market does get really anxious going into the election, but after the election, and if the Republicans do take control of the House and the Senate, or just the House, not the Senate, we'll have a divided government. And divided government is good for the market. Divided government is 61% of the time, and the market does okay. Does better when the Republicans are in charge, does okay when the Democrats are in charge. But you can look at that market, there's no big, as a matter of fact, I believe that the less government we have, if we have a divided government, there'll be less things that will be passed. No big initiatives will be done. No big government spending will be done. Because even if the House passes the laws, the president can veto it, or if the president wants something, the House and the Senate will not pass it. So if we have divided government, as long as we have less government, it is always good as far as the market is concerned. Looking at the economy, you can see that the supply chain are getting better. The supply chain is showing signs of easing. It had gone up due to the COVID virus, where we see Omicron here, and then we have started to come down again. Nowhere close to where we were in 2020 before the COVID, but we are moving in the right direction. Unemployment also, even though we got the unemployment number last week, which showed that we had created 570,000 jobs, but the job openings number is starting to come down, which is less jobs available. And that is always good. You can see that we going into recessions, and then the job openings drop off dramatically. And this is what we've seen after every recession. It's starting to come down now, the job openings, but we're not close to a recession, but we still have job openings, but they're starting to come down. As the unemployment rate goes up, as I've talked about for the last year, I know inflation is, I think, a big contributor to inflation is energy and labor costs. Energy prices shot up and labor prices have gone up. If the unemployment rate starts to go up, and I think the Fed can withstand unemployment going up from 3.5% to 4%, that will create enough anxiety in the labor force that we will see wage increases coming down. Oil prices have already come down. They've come down a lot. I think they're getting to the bottom of the range as far as oil goes. Retail sales still holding up. We got numbers from Walmart today. They were better than expected, even though Walmart had said that they're not going to, they had put out some profit warnings, but they said they were able to raise prices. Again, last year I talked about how if companies can maintain the profitability, raise prices, even though they're paying more for goods, but they still have that profit margin. As long as companies are making money, the market is good. Don't forget to join me for the daily edition of Market Wrap. You can go and download from the Apple Store. Just type in one word, Market Wrap with Mo Ansari, and there's a free app where you can get the daily edition, what I talk about on a daily basis, 1 hour broadcast, great guests. You can download that to your iPhone and you will get the daily edition automatically downloaded, and you can listen to it anytime you want to. Let's go and take a look at the technicals. Market, this is the 10-year note. Interest rates came down to about 2.5. Now we pop back up, and today we closed at 2.824, still below the 50-day. Remember, as rates come down, bonds go up. When rates go up, bonds go down. They work inversely. So interest rates had come down. Now they're starting to go back up. I think resistance is somewhere around 3% or so is where I see resistance. We're 2.82 today. So we're going to bounce around in rates until we get closer to the September Fed meeting. Then I think we could see rates going higher. S&P, last week I talked about how the 200-day moving average is critical. We came today, kissed it. Today's high was 4325.28. Market is 4325.28. You can see the market is 4328 is the 200-day moving average. So we came very close to it. I would not be surprised. This is wave 1, wave 2, wave 3. Everything moves in 4 waves. We should get a 4th wave pullback, and that could bring us down to 4200. This is 4128. This is a 20-day moving average, and the 50-day is all the way down here. I don't think we get down to here, but I would not be surprised to see somewhere around 4100. That'll be about a 200-point drop from here, from where we are now. Again, market can continue to go up. We should see some kind of pullback. I would start viewing those as pullbacks as buying opportunities. If you're already in the market, you're fine. If you have the right allocation, you're okay. If you're one of those people who unfortunately thought they were traders, they bought one stock, they're annihilated now, they're just sitting, now you're just a hold and hoper, as I call. Those are people holding and hoping one day they're going to break even. That's what happens to most traders. They make money slightly, slowly, and then they get stuck in one trade and wipe it all out. That's why having a diversified portfolio over a period of time, that's what creates wealth. And it's time in the market, not trying to time the markets. That's the advice I'd give all of you. Looking at the weekly chart, again, 43.43 is the 50-week moving average right here. We are at 43.26 today, or somewhere around there. Next, here's the 20-week. Here's the 50-week, here's the 20-week, and that is 40.74, and that's going to provide resistance. NASDAQ, wave 1, 2, 3, we're still 14,008 to 487 is the 200-day moving average. We are 13,102 as of the close today, so we could go up a little bit more. Pullback, fourth wave pullback takes us down to about 12.2 to about 11.7. Somewhere in that vicinity. If we can get anywhere between 12,000, I think between 12.4 and 12,000 is the number that I would be looking for, somewhere in there as a buying opportunity. If you're not already in the market, you should already be in the market. This is just an opportunity. If you raise some cash in the first part of this year, and that cash, you've got to start redeploying that cash on the pullbacks now. Weekly, my dot plot, as I always talk about, turned up in April of 2020, turned down in January this year, turned up 2 weeks ago. This was where the dots are above the market, it's a bear market. Dots are below the market, it's a bull market. So that's just a very crude way of looking at it, but we came down, we turned up 2 weeks ago, we've gone straight up. Now the dots have dropped to 10,689 today, so market has to come down way, it's 13,100. Support now is going to be 20-week, which is 12,133. Then the 200-week moving average, which is 10,000, 11,000 just about. Resistance is the 50-week, which is 13,681. So again, this now we've seen an ABC correction. Remember how this was a 1, 2, this was a 3, 4, and 5. Now this whole thing has changed to an ABC. Once we get a fifth wave top, then we get an ABC correction, and that's what we've seen so far. Oil prices below the 200-day, below the 20-day, below the 50-day. This is support right here, which were the highs that we made, somewhere around 87 or 85. Today we got to 85.73 as a low. Market has come down a lot. Again, we got Chinese data this past week, which was not good, showed that the Chinese economy is slowing. Demand for oil could come down. There are reports today that we're talking to Iran. There might be an Iran deal, maybe. But even if Iran does it, in 2015, when they signed the deal last time around, the nuclear deal, it took them about 6 months to raise production by about 700,000 barrels for the Iranians. So even if we do get an Iranian deal, which we'll see if it happens or not, but if they do, that's the only place we can get more oil from. It'll take about 6 months for them to increase production. Gold went up to the 200-day, failed, starting to come back down again. Closed today at 1790. Support is 1785, which is the 50-day moving average. Resistance is 1842, which is the 200-day. We came and kissed it last week and then fell straight off. So this is where we are now. I still think this was wave 1 to the downside, 2, 3. This is wave 4, and then we start wave 5 to the downside. If we break below 17 or this low right here, then we could accelerate all the way down to about somewhere around 1650. Market meter, I'm still positive on the market now. That's what I'm starting to look at. As you know, I was at 50. This is recession. Chance of recession are going down. Market is looking better and better. That's every day that goes by. September is usually a bad month for the market, so we could see some backing and filling, but I would use the market pulling back to add the positions that you want to add to your portfolio. Don't forget, next Tuesday, I'm going to do a 2-hour webinar where I'm going to go through the economy in detail, inflation outlook in detail, take a look at the charts and answer your questions live during that webinar. It's going to be on the 23rd, next Tuesday at 6 p.m. Pacific time. You can go to register at compak.com, compak.com. It's free. There's no cost. There's no obligation. You can be at home, sit in front of your computer, and get an update on what I'm looking at and why. That's next Tuesday evening. But you have to be registered, and you have to have an access code. Outlook ahead, I'm looking for the markets to continue to chop around. Think we've gone up as much as we can. Think we're going to chop around and pull back a little. But again, these pullbacks now should be viewed as an opportunity to add to your portfolio. Those are my views. Those are my opinions. Those are my thoughts of August 16th. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.